Turning now to our chart of the day. Bonds seeing a bump on bearish sentiment here. This is according to Bank of America's Global Fund Manager Survey. The report says that investors are shifting away from riskier equities and into a more risk-off approach. One contributing factor, credit access fears lingering despite the recovery from the collapse of regional banks like Silicon Valley Bank and worries that a downturn or recession continue to grow here. And so taking a look at our chart of the day, you're taking a look at the net percentage overweight equities versus bonds here, and particularly a few factors, one of which that we just outlined here, but another, especially as we're in the throes of, or at least the early moments of earnings season here, going to be interesting to see where some equities may catch a little bit more of a bid, given that you have a little bit more, at least for the next couple of weeks, a more muted Fed, and you're going to hear a lot of the tech speak start to come forward, especially over the course of Netflix earnings, Tesla earnings, and then even further as we get into some of the social media companies as well. But given more of an appetite, or at least an inclination to kind of get a sense of what a consumer is spending on right now and where that is still dovetailing into some of the core elements that make tech companies so profitable at the end of the day. That might be interesting to track here, especially given the bounce back in tech. But again, I think versus the bonds out there, that's just been kind of a no-brainer type of play that some have enacted in their portfolio.
I mean, it's true. People were looking for a safe haven. I mean, this is essentially going to be one of the best telegraphed recessions that we've ever seen. And then you add to that added credit crunch that people are expecting from the banking crisis. And Michael Hartnett commenting in that note saying, if consensus lust for recession isn't satisfied in the second quarter, the pain trade, where people get caught off guard, would be a rally in bond yields and bank stocks. And some of the biggest tail risks, the credit crunch, global recession, and inflation as well. So really causing that push that people are, they don't want that risk right now. They don't want to take a chance. Even as the Fed could at some point pause this year, a lot of people are still taking this more defensive stance and not wanting to take as much risk at the moment, Brad.
Yeah, absolutely.